Is coffee, mascara, and real estate.
Hi everyone, my name is Amanda Brandt and I'm a realtor with Coldwell Banker Hedges. This is my coworker, Bree Loeffler. We sell a lot of real estate together. And this is our good friend, Marcus Ramirez from Hills Bank. Marcus, go ahead and introduce yourself a little bit.
Yeah, hi, my name is Marcus Ramirez. I am a mortgage lender with Hills Bank and Trust, and I really appreciate you guys having me today.
Yeah, we are excited to dive into some questions about financing and credit. And Bree, why don't you start it off?
Sounds good, Amanda. I have the first question here for you this morning, Marcus.
Absolutely.
What is the first step you need to get pre-approved?
Yeah, the first step I would suggest as far as getting pre-approved is meeting with a lender. Obviously, you want to be sure that you're qualified for a home. So meeting with a lender is going to help you get qualified for your debt to income ratios, as well as your values as far as the house is concerned. I would also say probably getting with a realtor and finding out what's out there so you can kind of set your budget. And then also pulling credit, which is, obviously getting your credit looked at by a professional.
So when people come in to meet with you, what documentation should they bring? And I know it varies from situation to situation, but what are some of the basic things that you look at?
Yeah, income, and then also we also want to know about bank statements, right? So we need to have, think about it like this, right? We're trying to make up a case for that customer. So we want to know the credit, right? The ability, the stability, and then the equity, right? So if you're thinking of your credit, that would be obviously your credit score. Ability would be your ability to repay. So your income level, whether that's W-2 or self-employed. Stability would be your history as far as where you've lived and where you've worked at. And then your equity would be how much you have as far as funds, so a down payment. So think about income and bank statements and then a 2-year history of where you've lived and where you've worked.
I know we've talked about it in the past, but it's always frustrating when buyers haven't been in to get pre-approved, because then they set their sights on a budget that's higher than what they can get a pre-approved for, and then the rest of the homes don't look as appealing. So I know both of us always try to get somebody into a reputable lender such as yourself so that we can get that process started right away. So.
Yeah, and it's also super important that they meet with you as well to find out what's out there. Just because they've been pre-approved, they have an idea what they can buy, maybe not knowing what's out in the market. They might, like you said, shoot for too much house or look at buying a more expensive house than they can afford, and then they have to lower their standards going forward, and that can be definitely, so meeting with the lender is important, but then also meeting with a realtor is super important.
So one thing that I wanted to ask you is, how does your credit score affect your financing?
Absolutely. Credit plays a huge role. Let's be honest, credit is one of the biggest factors that go into it. And if you have a great credit score, then you can do so many more options, right? There's 100% financing that's available to you. There's certain programs that you can qualify as far as a better credit score, right? Less down payment is an option as well. So lower interest rates, right? I mean, there's just, the better the credit score, obviously the easier it is to get approved, and typically the better your interest rate's going to be, which means the more house that you qualify for.
Absolutely.
Very good. Okay. What are some steps that you can do to increase those credit scores if you may not have an ideal credit score that's a little bit lower?
Yeah, this is a really important factor, and I think this is one of the reasons that I really enjoy working with you two. With as much experience as you guys have in the finance industry, right, and doing finances, when you meet with a lender, if you're just another person and just another customer, another borrower, you may get your credit pulled and that's it, right? And then you don't really know what to do. When you meet with me, when you meet with these two, when we work together as we do, we can really set somebody up for success. So if you've had a few bumps or bruises along the way on your credit, one thing to do is obviously know what your credit score is. And I think that's where you want to meet with a lender, right? Have us pull your credit, right? Mm-hmm. It's a hard pull, which would be a FICO hard pull, but at the same time, that's going to allow us to see what's on your credit. A lot of people don't know about the collections they have, whether they're medical, right, or even from an old place that they rented. So getting to know that information is important. Keeping your debt utilization under 30% is also important, right? So what you have on your credit, and as well as your experience. So what you've been experiencing as far as, have you had credit cards? Have you had student loans? Have you had car loans in the past?
So one thing that kind of started this whole conversation where Bree and I wanted to talk with Marcus is I recently had a buyer that went in and talked to the lender, and they pulled her score, and they didn't tell her how to increase her score. And she's not in a hurry where she has to buy in a month. She wants to be in the next 6 months. And so by working with Marcus, we're able to figure out what we need to do to improve her credit score so she does get that lower interest rate and doesn't have to put as much money down. And a lot of it was really simple things. So just because you get one answer at one place doesn't mean that we can't get you in a better situation somewhere else with someone like Marcus.
That conversation actually stemmed another question that I have. So let's say you have, we have a client who really wants to save up to have a down payment on a home. They know that they have some credit. Would you recommend them saving their money to put a down payment on the home? Or would you recommend them meeting with you, take care of the credit report if there's any credits or judgments or what have you, to apply the money saved for a new home for a down payment, to apply those to the credit and get those cleared up first?
Yeah, I would definitely say it's meet with a lender first to find out where that money is best spent. If somebody can get qualified on a low interest rate on a mortgage, it may make sense to buy that mortgage at a low interest rate and use those funds to pay off debts that have higher interest rates. So just for example, if somebody has a credit card balance and it has a high interest rate on it, it may make sense to pay that down with the funds and use less money as a down payment. But that varies so much from person to person that I would say meeting with the lender is a good way to start. And then good communication as far as what their overall goal is, right? You know, what are they trying to achieve? Is this a forever home? Is this their starter home? What are they actually trying to achieve? Is it an investment home?
Right.
What are they trying to achieve? I think that's important.
Exactly.
Very good.
Well, if you guys have more ideas for us in the future, we'd love to hear about them, but we certainly hope that you found this informational, and we'd like to thank Marcus again for being here, and my awesome co-host Bree. So